Fund Launch Live with me, Daniel, the roll-in fund guy. Previously on all of these lives, I've broken down how different managers of 506c publicly solicitable funds have marketed their funds. The different copywriting and advertising tactics and the audience building that they've done to launch their funds. Today, I thought we'd do something a little bit more basic and talk about the structure of roll-in funds themselves, as opposed to the marketing. This is just going to be about this is going to be on the venture side of things. And what better place to start talking about roll-in funds than by the company that founded them? If you don't know, AngelList, Naval Ravikant's company, created the idea of roll-in funds in mid 2020. Now that story sort of got overshadowed by other events that occurred in 2020. Today, I figured we'll make this one shorter, a little more information dense, and just start very, very basic by going directly to AngelList, and I'm going to be reading their different FAQs about what roll-in funds are, how you can use them, and how you can set them up. So this will be a nice, short, simple one for you guys today. So we're here at AngelListVentureHelpCenter.com, and we're going down, and we're going to go into the leads, FAQs for GPs, for people who want to run syndicates, venture funds, and roll-in funds. We see here they have different sections in their FAQs: VC firm management, fundraising and capital network, fundraising and special purpose vehicle formation, fund operations, portfolio management, investor relations, taxes, international. But we are interested here in a structure: roll-in funds, always open venture funds. That's a good way of putting it. I've been phrasing roll-in funds thus far as one being publicly marketable, which is true, but that's not the only form of publicly marketable funds. It's not. You can market funds that aren't roll-in funds. And also I've been describing venture roll-in funds as being continuity for capital or capital on subscription. And that's one way that AngelList also refers to them. But it's good to think of them as always open. That's another advantage that roll-in funds have over the traditional venture fund. A traditional venture fund is like an event. You go out and you pitch 200 VCs. You need all of it to come together at once and get all the money in the pot, say on New Year's of 2022, and then the fund is closed. The money's there. You invest it over the space of 4, 6, 8 years, and then you go out and raise again. Whereas with the rolling fund, it is always on. You can always add more money in. So let's get to these FAQs. They have different sections here: basics, rolling fund setup, subscribers, making investments. Now, all in all, 11 plus 15 is 26, plus 9 is 35. 35 plus 22 is 57. There are 57 different entries for FAQs that AngelList has already answered about the structure of rolling funds. You'd think I'd start with basics here. I'm actually going to start with setup. I think that you guys might get some more interesting questions here on how to set up a rolling fund. Nope, I'm mistaken. We're going straight into basics. And the way they have these questions laid out, I wish that AngelList would order these according to order these in a more novice to experienced fashion here. For example, the first question under basics is, how do I disable DMs from prospective LPs? That's not the first question that someone who doesn't know about rolling funds would ask. They'd probably ask, who are rolling funds for? Oddly enough, it seems like the better questions are congregated down here at the bottom. So that is what I'm going to read. I'm going to be starting from the bottom, going up to the top, or at least halfway. We'll see how long we make this one today. So let's start. I'm not based in the United States. Can I lead a rolling fund? Yes, we can support, we AngelList can support a non-US based GP. It is important to note that the rolling fund entity would still be US based. And if you're wondering where in the US, rolling funds are Delaware corporations, so specifically Delaware. What benefits do GPs get working with AngelList Venture? We provide GPs and their LPs with a number of services, including fund management and accounting requirement, legal documents, regulatory filings, bank accounts, special purpose vehicles, fund pages, marketing documents, tax reporting, and Schedule K1 forms. We provide GPs and LPs with a number of services, including investor management dashboards, fund subscription management, subscription status and auto renew, minimum term commitments, fund distribution. We also provide portfolio management software, investment and company tracking, portfolio valuations, IRR, and internal recurring revenue, and other performance calculations. Which is a fun thing to note about the AngelList product. AngelList is a software company that doesn't sell software. You can't go to AngelList and give them a credit card and like subscribe to software in the same way that I'm subscribing to this live streaming software. But they have a variety of services for founders and LPs and GPs, and they invest a lot of software in making that service as intuitive and UX friendly as possible. I would love to get a GP to join a live stream with me just so that we can screen share and go and see exactly what your dashboard looks like when you're managing a rolling fund. As AngelList says, you get things like tracking paper value on investments made. You get to see who has turned on or off the auto renew for your next quarter's capital draw. You get to see who has increased or decreased their desired capital draw, etc. Think of Mint for VC. How much does it cost to run a rolling fund? Now we're getting into the meaty questions. Admin fee, 1.5% of contributed capital for maintenance of the fund's 10-year lifetime. $20K minimum fee, variable state and provincial regulatory fees, capped at $5K for each quarterly fund, 5% carry on AngelList LPs, no carry on your own LPs. So if you bring your own partners in outside of AngelList's network. Administrative fees are charged as a percentage of overall capital commitments to a quarterly fund, excluding any rollover capital contributions from earlier quarters and subject to caps. Much like management fees, platform administrative fees are collected upfront and paid out of a designated account set up for the fund. State and provincial regulatory filings are required by securities regulators in the US and Canada. In the US, state regulatory fees are known as blue sky filing costs. Fees vary depending on the geographic makeup of LPs in the rolling fund. If these fees exceed $5K per quarter, AngelList will cover the excess. So you as the GP will never pay more than $5K per quarter in regulatory filing fees. Now let's take a little look at these blue sky fees here. What are blue sky laws? Blue sky laws protect investors against securities fraud. Most venture offerings are exempt from blue sky law registration requirements, but fund managers often need to make notice filings with the state. I'm not going to read the entirety of this, but there's some, I've read this before and I want to bring some aspects of it to light. Blue sky laws are state-level regulations designed to protect investors against securities fraud. Good intentions. We all have different opinions on whether laws actually accomplish what they're supposed to, but it's a good intention to protect Main Street investors. Thanks to federal preemption, Most venture funds are exempt from such state regulation, but they still need to make a notice filing. Okay, now here we get into the meat of what I wanted to show for you. Blue sky laws and venture capital. In 1996, Congress passed the National Security Markets Improvement Act. This act amended the Securities Act of 1933, adding a new class of securities called covered securities, which are no longer subject to state securities laws. This is a federal preemption and takes precedence over any state-level requirement. Covered securities include securities listed on national stock exchanges and securities sold in accordance with Rule 506 of Regulation D under the Security Act of 1933. Now, if you've watched my content for any time, you know I use the term 506C funds. Here's where it comes from. Rule 506B under Regulation D permits private offerings, private deals, off-market stock, off-market equity, basically think ownership in companies that are not on the stock market, like startups. Rule 506B under Reg D permits private offerings to accredited investors. No general solicitation or advertising is allowed. In this case, funds and companies can rely on investors' self-certification as to their accredited status. So on a 506B fund, you are not allowed to advertise this to the general public. You have to make, I don't want to say backroom deals, but private offerings to people that you reasonably, only to an audience that you reasonably believe to be all accredited investors, people who have perhaps made investments with you before. So that's a limitation. But the benefit of that is that if someone slips in, if an unaccredited investor lies their way into their fund, you are not liable. The onus is on you as the fund manager to not advertise to non-accrediteds, but then the onus is on the LPs to be honest as to whether they are in fact accredited. However, 506C under Regulation D permits private offerings to accredited investors. General solicitation and advertising are allowed. Can I make this any bigger for you guys? Would that help? General solicitation and advertising are allowed. However, here's the catch. Funds or companies must take reasonable steps to verify the investor's accredited status. If you are promoting your fund generally, which includes you're making a tweet mentioning that you have a fund and that you're accepting an investment, then your fund had better be a 506C. There are some different regulations involved. The big thing here is that you have to take, quote, reasonable steps to verify accreditation. The good news is that AngelList provides that as a service. When you run your fund through the AngelList platform, they take care of verifying accreditation status. So for you as the GP, there's no extra work. That's what those fees that we discussed earlier are paying for. By the way, this 506C exemption, which allows general solicitation, was added in the Jobs Act. The Jobs Jumpstart Our Business Startups Act was passed in 2012, in part thanks to the lobbying of a one Naval Ravikant, the founder of AngelList. Okay, back to the AngelList FAQ. Anyways, these fees here, these admin fees, those go in part to pay for services like the fact that AngelList will ensure that everyone that all your LPs are accredited so that you can generally solicit and not have to worry about that catch there. Let's go back. How are management fees structured in rolling funds? Each fund will pay the fund manager a customary management fee. Management fees are generally calculated over the first 10 years of each fund's life and typically paid over 4 years. Like a venture fund, GPs can waive fees on an LP by LP basis. We have a graph, a second graph. Let's take a closer look at these graphs. Example, 2% management fee per year over 10 years. We have 4 quarters of a fund's life here. In our green, you guys probably can't see the text. This bottom green part of each bar is investable capital. So the money that's pooled, waiting to be deployed in the fund. From quarter 1 to quarter 2, same amount. We deployed a little bit in quarter 3. We raised a bit more in quarter 4, so we have more than before. On top of that is the admin fee. That goes to AngelList. It's 1.5% of commitments, or $20,000. If your 1.5% of commitments is less than $20K, then you'll pay a $20K flat fee for AngelList's services per quarter. Otherwise, you'll be paying 1.5% of commit. Management fee, which in this case, a 2% management fee on about 1.6. Yeah, so on let me reread my interpretation of the graph here. Starting at the top, contributed capital. If in quarter 1, $2 million, you get $2 million of capital from your LPs into the fund. Quarter 2, you get another $2 million in. Quarter 1, maybe some LPs dip, you get 1.5. Then in quarter 4, the remaining LPs like you enough, they want to double their commitment. You have $3 million. You have your top line here. You were given $2 million, then $2 million, then $1.5 million, then $3 million in each quarter. First of that, you have a management fee, which is going to be withheld. Take this first quarter, for instance, a $400K management fee on $2 million. So $400K is 20% of $2 million, which sounds like a lot. A management fee should be 2%, right? But the thing is that it was a crazy thing about the way that these fees work with venture investing is that you hear the fee is 2%, but that is 2% per year for 10 years. Remember, the structure of the rolling fund is that each quarter is an addition to a series of separate funds that are all owned by the same entity. So on quarter 1, when you get $2 million of investment from your LPs, they calculate a 2% fee times 10 years. So that's $400,000 that is withheld from the $2 million. And that is presumably held in escrow by AngelList. That is then paid out to the GP over the case of 16 quarters. So you're taking 10 years worth of fees, and then it's paid to the GP to run the fund over the space of 4 years, which in this case, a 2% fee on $2 million invested, that takes $400K off the top. And then that is paid back to if you then divide 400K by 16, and you guys can't see this on my screen, but I am using a calculator for this. 16. That's 25K per quarter that's being paid back to the GP. So out of 2 million in commitments, 400K is being held in escrow and then paid back to the GP in the amount of 25K for 16 quarters. It's kind of weird that it works out where the fee is calculated over 10 years and then reimbursed over the course of 4 years. That's the way it is. Then AngelList takes their own 1.5% fee, which would be $350K off of a $2 million draw, leaving you, the GP, with about about a 1.575 million left to invest, to make deals with for that quarter's funds. And then we have the second graph here of exactly how like I was saying, how the fee is paid out to the GP. Although the fee management is calculated over 10 years, 2% times 10 years actually ends up being 20% of contributed capital for each quarter, because each quarter is a separate fund. Now we're going back from quarter one to quarter one here. Remember that management fee, you had $400K management fee withheld. And then, see, in that first quarter, then the GP is getting reimbursed for $25K, which is 1/16 of the 10-year management fee, and we'll get that same fee again the next quarter and the next quarter and the next quarter for 16 more quarters. But then if you look at the graph here, you see kind of this step-like movement on the chart. That's because you have your quarter one fee, which is being paid out immediately for quarter one raise, and that's being paid out in you get your quarter one, then two, then three, then four. But then also you auto raise your quarter two money, and then you get to pay out another 25, 25, 25. And it's kind of crazy how these fees stack. It's actually wild because it's actually 20%. You as the fund manager if you use standard fees, you're entitled to 20% of the money you raise just as management fees. It sounds very small when you say 2%, but it's 2% every year for 10 years. But you don't even have to wait 10 years to realize it. It's paid out to you over the course of 4 years. Pretty wild. Why can rolling fund GPs talk about their fundraising publicly? Rule 506C, under Regulation D, allows for general solicitation or advertisement to the public for rolling fund GPs. AngelList Venture handles accreditation verification for all 506C funds on the platform. I told you. Does that mean that rolling fund GPs can publicly fundraise from anyone? The answer is a bit nuanced. While GPs can talk publicly about their fundraising, they can only accept capital from accredited investors. Under Rule 506C, fund managers must verify the accredited investor status of each investor participating in the fund. Wouldn't that create additional overhead for the GP? No, not at all. As part of our product offering, we verify all investor statuses on behalf of the GP. We want GPs to focus on finding the next wave of world-changing startups. Okay, 2 interesting points here. First of all, I'm not a lawyer, let alone a securities lawyer. But the research I did indicated that if you raise a 506C fund and you fail to verify someone's accredited status and an unaccredited investor slips in, that unaccredited investor can sue you for loss of capital because you, as the GP, allowed them to participate in a deal which they were unqualified to participate in. They as an unaccredited investor weren't able to consent to this form of investment, and you were negligent as the GP for allowing them to take part in it. 2, does this mean, I want to talk about this paragraph here. I talked to Taylor Welch yesterday, the CEO, the founder of Traffic and Funnels, really, really big, successful internet marketer who's now taking over real estate. And he asked me, I told him that if he raises money in a 506C fund, that he can monetize his audience in mass. He can raise funding from his audience in mass. And he wisely asked me, how can it be en masse if I can only raise from accredited investors? That's a good point. You can solicit en masse. You can make general advertisements. You could advertise at the Super Bowl for your 506c fund. But ultimately, you can only allow the accredited investors in. Also, as we'll talk about soon, there's a limit to the number of LPs that you can have in a fund, in a 506c fund. So is it fair to say that you can raise money in mass if, one, you can only raise from accredited investors, and two, there's a limit to the number of LPs that you can have on each fund? I think it is fair to say that you're raising money in mass because, one, by being able to solicit, you are exposing the opportunity to the broadest possible pool of people. You could put an ad up on the Super Bowl, and although only a fraction of the viewers may be accredited, you could theoretically expose yourself to every accredited investor in America. Right now, the estimate is that around 10% of households have accredited status. And when we talk about rolling funds, we're usually talking about it in the context of the tech crowd. I'm guessing that most accredited investors are not in the tech crowd. They're probably more so doctors, lawyers, real estate agents, people who do meet the income threshold, but don't have exposure to the world of early stage startups. And that is potentially an untapped pool. If you can be the bridge between these tech unsophisticated accredited investors and early stage startup, it's possible that you could have a very large pool of capital to draw from. Also, the fact that you have a limited number of LPs that you can bring into a rolling fund, I think that's a good thing for you as a fund manager, because it creates a natural exclusivity, scarcity, and urgency. If you only have 99 seats available at the table, but you're able to put an advertisement out to 10 million accredited investors, you are then able to bid them up against each other. Whereas, there's 10 million people who are interested, or at least 10 million people who are qualified, and say, 10,000 people who are interested in investing in your fund. When you can only take 99, it's like an auction, and you're able to constantly raise what the minimum commitment is. And each quarter, you can have prospective LPs bid up against each other for access to the fund, because there really is a natural source of scarcity. So, where are we? There are 22 articles here. We just read through 5 of them. We're at 30 minutes here. I'm trying to make these broadcasts shorter so that they're less rambly, more concise, more impactful. I'm going to end it here. I think that I'm going to make this reading through AngelList FAQs a little bit of a segment, and I'm going to exhaust them maybe once a week. I'll do a section just reading through basic FAQs. Anyways, I hope you guys got some good information about rolling funds, syndicates, and other 506c publicly marketable securities. Thank you guys for watching. If anyone did, it is truly a pleasure. I am Daniel, the Rolling Fund guy, and I live on Twitter, so give me a follow. And I will see you guys tomorrow, because I do these live streams every day. That includes weekends and holidays.